Welcome to the most important lecture of the phase 1 and the last lecture of the phase 1. If you understand this concept, and trust me guys, I have not spoken about this concept before anywhere else, so I want you to pay close attention, I want you to take notes, and I want you to take this seriously as possible, because if you understand this, you are going to be a master at reading charts and understanding how the price works. So guys, let's get to it and talk about liquidity. Now before we talk about liquidity, I wanted to explain you what is exactly liquidity and why is it so important. So I'm sure by now you understand that the entire market works on supply and demand. The entire market works because of buyers and sellers. If somebody is buying, that means somebody is selling. If somebody is selling, that means somebody is buying. And that's exactly how the market works. If, for example, let's say I want to sell my car for 1 crore rupees, or let's say if I want to sell my car for $300,000, but there is nobody who's willing to buy at $300,000. That basically means there is no liquidity. The market is not liquid. The market becomes illiquid, right? And that forces me to either lower my prices down or take my prices to a level where there is liquidity, where somebody is willing to buy. And that is exactly how the market works. Now, sometimes the market becomes illiquid, and that is exactly why it seeks liquidity. It wants to go to the area where there is liquidity, which helps the market do what it wants to do. And that is exactly why it is so important for you to understand this, because a lot of times the market is going to behave in a certain way where there is a lack of sellers or a lack of buyers, and because of that the market is forced to come to a certain level where there is sellers and there is buyers present, so that the prices can move smoothly and the market, big fishes, the whales, can do what they want to do. And that is exactly why it is so important for you to understand how liquidity works and why it matters. Let's get to the charts. All right, so here we are at the charts. Let me give you an example of how exactly the liquidity works and why is it so important for you to understand. So now let's say there is an uptrend going on, there's a healthy uptrend going on, prices going up, everything's just going fine. Now there will be a point where the market wants to go higher, but it is struggling to go higher, right? So let me simplify this for you by making a line chart. So if you look at this, the market wants to go higher. Now, normally after this move, we should expect something like this, because there's a very good uptrend going on. But here you can see the market is struggling. The market struggled to make a new high, which basically means there's a lack of buying pressure, there's a lack of buyers. That means there is a lack of liquidity, right? From the buying side, the market wants to go up, but there's a lack of liquidity from the buying side, and that is exactly why the market is not able to go up. Now, if the market needs more buying pressure, it needs more buy side liquidity, what is it going to do? It will be forced to take the prices lower and collect more liquidity, come to a point where there are more people who are willing to buy, and then push the prices back up higher. So that is exactly what I gave you as an example from the car perspective. I gave you a car example, right? If I'm selling my car for $300,000 and nobody's willing to buy it at that particular level, that basically means I will be forced to sell it at a lower price where there is liquidity, unless I just want to hold it and not sell it at all. So the price is forced to come down violently to a certain level where there is enough liquidity. So now let's say this entire area, which also happens to be a support region, there's a pool of buyers. So this area is entirely filled with buyers who want to buy, who are waiting for the prices to come down and who want to buy. So the price comes down, collects the liquidity over here from this pool, and then decides to go higher. Because now the amount of buying pressure the price is going to generate and going to collect, it is going to make sure that obviously the price goes higher, because now it has a lot of buying pressure. So this is exactly how liquidity works. Same thing on the sell side. I'm going to give you an example for the sell side as well. All right, so here we have a sell example, a beautiful sell example when it comes to gold, right? So let's see what is happening over here. So the price is trying to go up, but then the uptrend failed, the price came down. Now the price has been fighting. There has been a battle between the buyers and sellers. You can see over here. It might be looking extremely confusing to you, this entire movement. The price is trying to go up, trying to go down, whatever is happening. But now here we can clearly see, if you go and switch to the line chart, we can clearly see there is no buying strength at all. The buyers are genuinely struggling a lot. Even if you look at the strength and momentum of this entire price structure, you will see major moves are in favor of the downside. Major moves are in the favor of the downside. There's only one move that is in the favor of the upside, which is once again overpowered by the downside. right? So here you can clearly see that the price is struggling to go up, which basically means if the price is struggling to go up, there is no buying pressure. If there is no buying pressure, the price is struggling to go up, that also means that the price might go up, take all the liquidity and then go down. There's also a possibility that the price might go down, take the buy side liquidity and then go up. So now what we have to do is just to wait and watch. Wait for the price to give a sudden move, collect liquidity on the either side, right? So let me give you an example. So what do we have here? We have an extremely aggressive selling pressure from here, which basically means that obviously there is a lot of sellers waiting here. Then we've also got an extremely aggressive buying pressure from here, right? So we've got two support and resistance zones. So let's say we are somewhere at this level. Now we are confused that whether the price is going to go up or price is going to go down. So what we are going to do is we're going to wait for the price to do a violent move. We are going to wait for the price to maybe do something like this or do something like this, collect liquidity and then give us a move. Because when the liquidity is collected, then it is helping us understand where exactly the move is going to happen. Now again, let me give you another example. So let's say you might be confused. Okay, so let's say if the price goes ahead and does an extremely violent move on the upside, something like this. If the price does something like this, then what am I supposed to do? I might be extremely confused. But before this upside move, did the price collect liquidity? I don't think so. And that is once again another good way to understand. So if you get confused, it's a very good way to understand that if the price is going to sustain at the higher level or not. Again, if you look at this particular move, the price went up and then suddenly came down. Why did it happen? Look at this. There was no buying pressure. The price did not collect liquidity. The price went up, did not sustain, did not collect any liquidity. Price came down, again back to the support. It collected liquidity now and then went up, right? So if there's a violent move happening without any significant pullback or without any significant correction, that probably is a trap, right? So now again, in this example, the price is constant, price suddenly goes up, takes all the stop losses, collects all the liquidity sitting here, collects all the sell side liquidity sitting here, starts going down. So guys, this is called a liquidity sweep. This is called, once again, you can give it hundreds of names, but this is called a liquidity sweep where the price collects liquidity, decides to go in the opposite direction because obviously it has been struggling to go in that particular direction. So this is a sell side example. Once again, don't get confused, but practice. The more you practice this, the more you will understand how exactly liquidity works and why it works in fact. So once again, look at this. So here we've got a decent support zone, right? The price gave a violent move from here. The price came down, collected liquidity right here. You can see the violent move on the downside, collect liquidity, and then price is going up from here. So guys, if you just understand this, if you just practice this, and if you understand how liquidity works, and then you support and resistance, strength and momentum, volume analysis, and you combine all of this, this is going to give you such an amazing understanding about how the charts works, amazing understanding about the technicalities, and you know how the price works. If you understand this most important concept of liquidity, you are going to be a master reader of charts, and you're going to be understanding. Once again, let me give you another example. Because normally liquidity is like fuel. Liquidity is fuel for the price. If it does not collect fuel, if it does not go to the, if a car does not go to the petrol station, it is not going to go far, very far, right? And that is exactly why we have corrections. That is exactly why corrections happen in the market. Again, Bitcoin prices was going up, came down, took the liquidity from the support zone, and then now it is going up. Always remember, whenever the price comes down to take liquidity, it will always take a liquidity at a strong support or a resistance zone, because obviously that is exactly where the liquidity is. That is exactly where the buyers and sellers are waiting. And that is exactly what you need to understand, because this is extremely important. And if you have understood this, this marks the end of phase number 1. I will see you in phase number 2.